Twitter is a great social platform, but is it a great business to invest in? In this video, I will analyze Twitter as a business. So if you consider investing in Twitter, you should watch this video. My name is Nir and I'm a value investor who like to follow Buffett and Munger practices. The analysis I will go through here is also in a written form in my website, and you can see it right now on the screen. I recommend going through the written form as well because it includes many interactive graphs for you to watch and maybe get your own decisions about the company. And in the end, we will get to that in the valuation part. I have a dynamic form in the site for valuing using DCF analysis. So if you want to try it for yourself, I recommend going to the site and watching the graphs, adjusting the valuation to get what you think is right. Because I'm just a guy at YouTube. I might be wrong and you might get to other conclusions from the things that I will show you here. So let's start by talking about the elephant in the room. Twitter has underperformed the market in the past several years tremendously. And the market pushed Twitter prices down, justifiably so. To name a few culprits of Twitter in the past years, we have inconsistent revenue growth, lagging performance of other companies in the field. If you look at the ARPU, the average revenue per user, they are far behind competitors like Facebook. They have untapped opportunities that are unique to them, and we will get to that they didn't touch for years. They missed market opportunities. All other social platforms skyrocketed through the COVID event, while Twitter lagged behind and didn't have those sweet revenue growth that other social platforms had due to the stay-at-home orders. Twitter management seems oblivious to Twitter, mostly Jack, that seems to care more about Square than he cares about Twitter. They had destroyed fantastic opportunities by any measurement, like Vine, that should have been the next TikTok, and Periscope, that should have been much, much bigger, and many more other culprits of Twitter in the past few years. All these culprits pushed Twitter price down, and justifiably so, but I claim that the price has gone down too far, and right now with the new opportunities open to Twitter and the new velocity of the development of the product within Twitter that we saw with review, with fleets, with spaces, I think the upside is much larger than the potential downside. And actually this opportunity became so clear to me 3 months ago, and I wrote about it in Twitter that I took the position, and just out of sheer luck, I don't claim that I was that smart, it was pure luck, I bought at the absolute bottom at $39, which is the day of the tweet, and up until now, I locked more than 70% gain, but yet I think the price of Twitter is low enough that it's still a good opportunity right now, and we will get to that. So let's go through a quick business overview. Twitter is a social network that is based on the follow model, like Snapchat and Instagram, where one person can follow the other without the other be really in this interaction. That is opposed to the friends model that Facebook have. Twitter is more of a text-leaning platform. Although you can share images and videos within Twitter, the being leaning into text caused the communities within Twitter to be more knowledge-based. So you have news sharing and breaking news, talking about current events, and we have also knowledge communities within Twitter. We have the investing community, which I am part of, which is called FinTweet. You have a lot of programmers. I'm also a programmer, so I know about a lot of programmers' clicks within Twitter. And many other. We have music producers and many other communities I don't claim to even begin to understand. So this unique position of Twitter being text-leaning and creating knowledge communities and knowledge sharing communities within Twitter opens up special opportunities for Twitter that other social platforms just doesn't have. You can't have really deep knowledge sharing and discussion within platforms like Instagram, for example. Next, let's look at the current revenue drivers of Twitter. Right now on the screen, you can see the graph of revenues of Twitter since 2017 by quarters. And I divided it by the divisions that appears in the reports of Twitter, that is division to advertising and to data licensing and others. And I recommend going into the site that I have the link down below in the description, because as you can see, this graph is dynamic and you can see the real values, the total growth, and the year-over-year growth of the data. So if you want to go a bit deeper on your own time, you can do that. So looking at this revenue split, it tells us that first, advertising is the primary revenue source for Twitter. Data licensing is not something that's really growing. In the past years, people thought that Twitter might license a lot of its data for bot analyzers and things like that, and it might be a growing market, but apparently it isn't. Also, we can learn that Twitter is struggling to push the revenues in the past few years, and of course that the last quarter was amazing and a complete outlier from the other quarters, and that explains the recent stock rise. You have one great quarter and suddenly everyone rush into the stock. But that's just looking at Twitter. I claim that they, even with the last quarter rise in revenues, they still really underperform the market when you compare them to other social platforms. So right now you can see in the graph the uplift from revenues in Q4 of 2019 to Q4 of this year, of 2020, and you can see Twitter has only uplifted in 28% in their revenues growth, whereas Pinterest did 76%, Snap did 62%, and even Facebook, that is already huge and you might think they don't have much room to grow, they grew 33%. So Twitter really dropped the ball in the last year on the potential of the COVID event for social platforms. Let's focus about the future of the advertising revenues for Twitter. So there are two main drivers to boost up the advertising revenues for Twitter. First is having more users in the platform, and second is raising the amount of advertising revenues you get from each users, known as ARPU, average revenue per user. Now, raising the revenues per user can be done in multiple ways. One might be having a better advertising platforms for the advertisers that they would want to pay more, or in the other side, having the users more engaged with the platform so that they will see more ads. So let's really start with the ARPU. In my opinion, the potential uplift for ARPU for Twitter is massive. If we look at competitors right now, Twitter is having $16 ARPU, while Facebook having $32. Now, the Twitter number is an estimation because they don't publish it in their reportings, but it's a smart estimation based on other data they report. So even if I mistake by $1 or $2 or even $3, the significance is still here. It's $16 versus $32. That's almost twice as much revenues per user that Twitter can have. Now, I don't expect Twitter to get to Facebook's levels because what they do is absolutely crazy, but I think it's reasonable to expect at least 25% uplift just in the ARPU. Now, we're talking about a completely stagnant platform in terms of users. Just the current users with their current engagement, we can have 25% more revenues per users, and because advertising is the most significant aspect of revenues for Twitter, 25% uplift in ARPU might translate directly to 25% uplift in the revenues for the company. Now, the second measurement is users. Twitter measures that as MDAO, which is monetizable daily active users. We measure it for reasons like bots in the platforms or users they can't really monetize. So we differentiate the monetizable users from non-monetizable, and we want to focus on the monetizable users. Now in front of you, you can see a graph of the growth in the monetizable daily active users of Twitter since 2017, divided by Qs. Now, as you can see in this graph, again, you can see it for yourself in the written article in the description below. Let's look at the total growth, for example. So we can see in 4 years, we had a total growth of 76% in the users. And when we look at year-over-year growth, we can see that it accelerates. Not only that Twitter is growing its user base, it accelerates in the growth speed, growth velocity. So if in 2018 they grew by about 10%, in 2019 they already grew by 15%, and by 2020 they grew by 28% their users from the year prior. So that makes me really bullish about the advancements of Twitter. Next, let's talk about the new monetization paths for Twitter, namely the creators economy, which they tap into by purchasing Review. So Review was a company for paid newsletters, and that signifies, and now Twitter has already launched the super follow feature that shows us that Twitter wants to allow their users to monetize their content through the platform itself. So up until now, we always saw people driving their customers to purchase their exclusive content outside of Twitter. They drove you into buying their books in Gumroad, buying their courses on Udemy, or just buying a paid newsletter in Substack. This new feature will allow the content creators to keep the users within Twitter, so they can acquire their customers through Twitter, through the open tweets, and also funnel them into the paid content through Twitter. Now, this model is nothing new. This model is already implemented in, for example, YouTube members, where the content creators acquire the users using the YouTube algorithm, creating free content in the platform, and allows users to create a membership within the platform to get exclusive content just for them. And it works great, but video is one side and Twitter is more based on text, as I said in the beginning. And the potential for Twitter, basing on text and in some part on images, is to be a great competitor to things like Substack and Gumroad and even Udemy. And in my opinion, there is also a flywheel effect here, as creators will be able to monetize their followers in Twitter. More creators will come to Twitter to create the free content to acquire the followers and to sell their exclusive content, which will drive more users into Twitter to consume both the free content and the exclusive content they need to pay for. So this is, in my opinion, a great flywheel effect that will drive growth for Twitter in the coming years. Now, I think estimating how big it will be is a fool's errand, because this has a great potential for really big outliers that I just can't predict. Imagine Taylor Swift or Obama starting a paid newsletter within Twitter. Just imagine how many people will pay the $5 or $10 or $15 a month to get exclusive content from Taylor Swift. We're talking about millions of people, and just one really big creator like this can generate so much revenues that trying to estimate and taking the numbers of current estimated creators in Twitter by thinking how many people in Twitter have more than 10,000 followers, for example. I tried doing it, but the estimation is so far away that I think it will be just useless to try to estimate it. But as you can see, I really think it has really good potential. At least potential to compete with Substack and Ghost and all the new platforms for content creators. So now after we talked about the business, let's talk for a bit about the management. The biggest bear case for Twitter is its management. They messed up so many things in the past that it's easy to just believe we will continue to mess it up. They had stagnating revenues for years. They missed the COVID opportunity. Their platform lacked innovation for years. They destroyed great opportunities again, like Vine, like Periscope. I think if they don't, they really should. A lot of MBA programs need to teach in their classes how to destroy businesses like Vine, which is just amazing. Everyone who follows Jack get the feeling that he cares much more about Square, which I get. Square is a great company, but he's also the CEO of Twitter, and that gives investors the feeling like, okay, Twitter is profitable and it's nice, so I don't have really the drive to push it forward. That's at least the sentiment of the investors. But I claim that something happened in Twitter recently. Something that made them much, much better. So if I look into the recent product velocity of Twitter, it's amazing. They launched Fleets, they launched they bought Review and almost immediately launched the Super Follow feature. They launched Spaces, which Spaces is really astonishing to me because the opportunity came after Clubhouse started getting all the traction. And then Twitter, which is supposed to be a heavy company, a corporate, a public company that moves a bit slower, especially compared to a startup like Clubhouse, they launched Spaces in absolutely no time. And they even got into Android market faster than Clubhouse. So think about it. A slow corporate, that is, launched a product faster than the new lean startup. I can't really point to what happened in Twitter that led to all of this, but right now I get the feeling that the management and the product of Twitter is really doing hard work, and I'm really optimistic about the future. Guys, if you got to this point in the video, you probably enjoy it. So if you really enjoy it, please leave a like. It helps me a lot with the YouTube algorithm. And with that said, let's continue. Let's talk about the moat of the company. Twitter, of course, have the classic network moat where you want to be where everyone is. This effect works great for a lot of products. We can see it with Facebook, for example. If Facebook didn't have all the people in it, it would be a ghost town, no matter how good its feature would have been. And Google Plus proved that much. So we already know that network moat is a deep moat, and incremental improvements to competitive products wouldn't drive users from the current product to the new one. But I claim that Twitter has something more. All the other communities like Facebook and WhatsApp, for example, they base on network mode that is mostly local. Even if the entire world would have been in Facebook, except from your friends, from your town and your country, it wouldn't make any difference for you. You wouldn't have anything to do, at least initially, in Facebook. And it's more extreme in apps like WhatsApp, for example, because you need to chat with the people close to you. And you can see right now an image I took from messengerpeople.com that shows what is the prominent messaging app in every country. And because the network mode is so local within these kind of social networks, you can see some countries have WhatsApp, some have Facebook Messenger, and some have Viber or even WeChat or Line. So it really, really depends on the local mode. But what I claim is that Twitter has more than a local mode. Because of how it's organized and how it's show its data, you can be a part of community regardless of your local community. You can just join Twitter and be part of the free tweet community or the programming community. And even more than that, you can be in no community and still be in a community. What do you mean by that? For example, let's take the current events with the hashtag abolish the monarchy following the Oprah interview. I'm not really interested in the monarchy. I'm not a UK citizen, but in this case, I wanted to see what the people say and react to that. So if I went to Twitter, the hashtag was trending, I just click on it and I'm immediately a part of a community, and I can interact with specific people that interest me. Let's compare it to something like Facebook. If I'd like to see what people say about it, how would I go about it? I search for a group called Monarchy Chat. I don't even know how to approach it. And that's the problem with Facebook and other social networks that don't have this global community that Twitter has. So I think Twitter, on top of their network mode, they have this global community mode that just enhances their network mode much stronger. Now to the fun part of every stock analysis, valuation. It doesn't matter if the company is great, if it's too pricey. Let's try to value Twitter. And doing so is a hard task because, as I said, Twitter most valuable asset is its people and communities within Twitter. And when we things like the creators monetization or features like spaces that we don't have any idea where this will take us, it's hard to predict the growth of these kind of things in the future. So what I will try to do is look at the past advertising growth revenues, so the classic model of Twitter, and use it as a baseline to expect this growth to continue, and have another bull model that will say, okay, this is what will happen if we have extra growth on top of that, without really getting into the details of how much growth the other things will provide for Twitter. But I will give it a sensible growth, like not another 100% growth. So we will get to it. To start estimating the current growth, I'd like to first look at the Ebitda. So right now you can see a graph of the Ebitda growth since 2016. You can see the real values and the total growth, and you can also switch to quarterly data. Again, if you want to play with it yourself, you can do it on the article, again in the link in the description. The second thing I'd like to look at is the owner's cash flow. Owner's cash flow is sort of adjustment like the owner's earnings of Buffett. I look at the financial statements of Twitter and get a sensible number for the owner's cash flow, because if you try to look at the free cash flow as is for Twitter, it's heavily skewed by one-time things and you can't really take any conclusions from it. So right now you can see the owner's cash flow on the screen, and you can see its growth and its year-over-year growth, and it's pretty much in line with the Ebitda growth. Now looking at these graphs, you can see it go up and down, mostly up until 2018 and then down, and it's really hard to get any conclusions from that. So I digged into all the financial statements and the history of Twitter to understand what happens there. And what we can see, one effect of it is really the revenues did go slightly down in 2019, and in 2020, Q2 of 2020 was a huge loss because of COVID for Twitter. So that explains that. But on top of that, we have higher costs for the operations of the business. Almost every cost, R&D cost, administration cost, and other expenses all went up since 2018. So it started high, relatively high in 2016. It went down in 2018, which was the perfect storm where revenues went up and the costs went down. And since 2018, the revenues went slightly down and the costs went up. But if you take all these kind of things into account, all the fluctuations, and you try to really build a model of how well they grew their revenues and their bottom line without things like COVID or the costs going higher, just to get the growth percentage, the conclusion I got to is that they had a growth of 20% per year for the last 5 years at least. But in my model, in my DCF model, I will use 15% just to give it a little bit of margin of safety there for the baseline. For the bear case, I will use 5% growth. And for the bull case, let's say that the super follow will really explode, I give 25%. So it's pretty much sensible, and I want to see what the valuation method will give me. So right now on the screen, you can see the valuation calculator for my site. Again, if you want to mess with it yourself, go into the link in the description. I use discount rate of 20%, the current cash flows that I found using the owner's cash flow, and you can see the three models, the bear model, which is 5% growth, the baseline, and the bull. And for each, I gave a different probability of happening. I think the baseline is 60%, the bull is pretty much probable, at least in my opinion, so I gave it 25%, and the bear case have 15% chance of happening. If you disagree with me and you want to change the probability chances for each model and get your own number, go to the site. This is why I built it. For terminal values, I use the price to sales multiple that almost always was at 10 for Twitter, even though right now it's at 18, but I don't expect it to remain there. So I used 10, and with the growth of sales in each model. Now you can see the intrinsic value and the purchase price on the screen, and you can see that we talk about $43 billion purchase price. Right now, Twitter is a bit above that, but it was below that when I bought, and this is the reason I bought it 3 months ago. But it's not that much above that, and it's not within the intrinsic value with the risk-free rate of 2% as of now. So I think Twitter is still a buy, and it's a great opportunity right now too, at least based on my models. So that's it, guys. That's my Twitter stock analysis, stock and company analysis. If you enjoyed the video, please leave a like. It helps me a lot. And if you have any questions, or you think that I made a mistake, you have other opinions about Twitter, please write them in the comments. I really like to learn from you. If you watched this far, I think you probably have some kind of opinion. So please share it with me. And with that said, I'll see you next time. Bye bye.